Hi, this is Brett Cenkus with Cenkus Law and Braaten Woods. Cenkus Law is a business law firm focused on M&A or mergers and acquisitions. Braaten Woods is an M&A broker. Two very different skill sets, legal and marketing and sales, both focused on what we call the emerging middle market, which is businesses selling between $2 and $20 million. If you like the video you are about to watch, subscribe, share it, ask a question, or head on over to merger-resources.com, which is a collection of entirely free tools, templates, checklists, articles, videos, all sorts of stuff, all about M&A. It will supercharge your learning, and again, it's all free, merger-resources.com. Hope you enjoy the video. Hi, today's video is about two different ways to handle working capital in an M&A deal. So working capital is current assets minus current liabilities. So most businesses, that's cash and accounts receivable minus accounts payable. There could be inventory, which would be added to the asset side of the equation, but in a service business, you wouldn't have that, of course. There could be deferred revenue, which is like prepaid revenue, would be over on the liability side. Short-term loans and stuff like that. But a lot of times in M&A, the debt's all going to be paid off at the closing table. So when we're talking working capital, we're often talking accounts receivable plus cash minus accounts payable. That net is your working capital. And in the US, we typically use what's called the closing accounts approach. And we're going to distinguish between that and the locked box approach, which is what they generally use over in Europe. And we're going to talk about pros and cons of those. In the closing accounts approach, what happens is the buyer and the seller reach an agreement on a headline price, a purchase price for the business. Often they'll do that at the time that they sign a letter of intent or term sheet, which is non-binding except for usual exclusivity and maybe confidentiality. The exclusivity it stops the seller from shopping the deal around. And now the buyer comes in and spends 30, 60, 90 days doing due diligence, kicking the tires, looking at everything. That's when they get their auditors and accountants in there to look at the accounts, and they'll come up with a target working capital number that's fair for the business. Sometimes it's done at the point in time the letter of intent is signed. Other times it's sort of that can is kicked, and along the way the parties come up with what they believe it ought to be. So between signing that letter of intent and closing, the diligence is being done, we've got our set purchase price, and then we've got a target working capital number. So right before closing, sometimes there's other adjustments. On the day before closing and the day of closing, the seller will usually prepare a balance sheet that shows what they believe working capital is as of the day of closing, or will be as of the day of closing. Now, it's not 100% accurate, or rarely is, because most businesses are in flux. At any point in time, there's money coming in and out, and you can't really know exactly what it is. Sometimes there's more complicated mechanisms for dealing with bad accounts receivable and stuff like that. So it's like it can be a little bit messy, and it's hard to know exactly what it is on the day of closing. So we've got the purchase price, a target working capital number. We don't know exactly what it is. But at the closing, the parties have an idea, and then typically the purchase price is adjusted a little bit to take into account the shortfall or the excess above or under the working capital target number. So let's say the business sells for $5 million. The target working capital number the parties decide on is $500,000, and on the day of closing, the seller believes it's $600,000 in working capital. The buyer will pay an extra $100,000 to the seller. The purchase price is going up a little bit. But that's not the end of the story. It's just beginning from the standpoint of working capital. Because after the buyer, remember, on the day of closing, we don't know exactly what it is. We have an idea, and we know what the target is, what we need, what it's supposed to be. We know approximately what it is. We don't know exactly. The buyer gets the business, gets the keys, gets in there, and once they understand the business and the books and all that, the buyer will generate its own calculation of working capital as of the day of closing. The buyer will say, okay, I know what it was supposed to be. I know what you think it was. Here's what it was. Now, in the here's what it was, there's a lot of opportunity for disagreement. Now, number one, even though all of this will generally be covered by, the way the books are done will be according to GAAP, which is generally accepted accounting principles. GAAP isn't perfect science. It's standards. It's not always exactly do this, do that. So how the buyer might do things, how their accountants might do things, it may be a little bit different from how the seller does it. You've got an inherent sort of misalignment of interests. Maybe the buyer's going to have a desire, obviously, in minimizing the working capital number as of the day of closing, because it means they might be due a refund, or they're looking, obviously they want to have negotiated for the highest working capital number as possible, but then in terms of saying what it was, the lower the better, because then they would just get a check from the seller. So there's a little bit of a conflict there. And it's not done collaboratively usually. And then when it starts to get complicated, distilling the business deal, as a lawyer, that we take the business deal, we put it on paper, it can be really challenging. And there could be a disconnect, and you don't always know, are you really, are the principals really understanding what this says? Usually the accountants aren't looking at it. So it's like taking their deal, getting it clear, getting it on paper, and then with the misalignment of interest, there's a lot of opportunity for problems to occur. So there's a lot of litigation around that. Now, the alternative is what they do in Europe mainly, which is the locked box approach. So back to in the US, the parties set a headline purchase price number. Somewhere along the line, they get a working capital target number, and then they close. Along the way, it doesn't matter what the seller's doing. Now, contractually, the seller may be prohibited from taking money out of the business or doing different things, but usually the buyer doesn't really care. It doesn't matter, because ultimately the buyer knows I've got to get it with X amount of working capital anyway. So if you take all the cash out of the business, sometimes that's we're doing that on purpose, but it doesn't matter because the buyer's going to get what the buyer expects. In Europe, with the locked box approach, that point between signing and closing, adjustments in the working capital are for the benefit or detriment of the buyer. So the buyer and the seller agree on a $5 million price and the balance sheet as of today. We just agree on the deal, and it doesn't matter what happens between now and closing from a working capital perspective. The buyer doesn't have to be worried about the seller riding the trade, which is where the seller just doesn't pay its payables and collects really aggressively out its receivables. They don't have to be worried about that, because all of the benefit and the detriment of the receivables and all that action goes to the buyer. Now, that means that the buyer has to do a lot more work up front before they even get to a purchase price, before they even decide on the deal and they accept a balance sheet. The buyer needs their auditors and accountants in there really aggressively understanding the business. That's more time and money spent up front, but it's less on the backside. And up front, anything that the buyer's seeing, they're going to bounce off the seller, they're going to talk about it, they're going to reach an agreement, they're both going to feel good, and they're going to cement it, and that's the end of story. Okay. Whereas in the U.S., to get deals to a table quickly, we kick this problem kind of, and it's sort of front loaded in Europe, and that works better if what you're concerned about is more minimizing disputes and disagreements. The locked box approach could be much better. It's not perfect, and again, you're shifting cost and time up front, but it works well for that. There's a concept called permitted leakage, which allows the seller to take some money out of the business or do different things, but again, you're pretty much freezing the working capital in effect at the time you agree to the purchase price and you set a balance sheet, and you don't worry about what happens between then and now or after the closing. It's all taken care of up front. So two very different approaches. We rarely use lockbox here. In fact, I can't recall. I don't even remember last time we would have used that. But I think it's a good tool, and it's something that we should take a look at and maybe use, and especially in a more complex business or one where there's less trust, or for a bunch of different reasons, it might be better just to get that all out up front rather than kicking it to post-closing, because working capital disputes are an area that is really ripe for litigation and disputes, and it's challenging. So I hope you enjoyed the video. If you got any thoughts, if you use the lockbox approach and have a preference one way or the other, drop a comment or ask a question. We'd love to hear from you.